Welcome to Investors Guide. I'm Faye D'Souza. Thank you so much for tuning in. Of course, we had the Finance Minister present the Union Budget last week, and we saw several announcements that affect a lot of us, whether we're senior citizens or ordinary investors. Things about the NPS, about how we should save for our pensions, about how we should consider increasing perhaps our health insurance coverage. All of that we're going to talk about on this show. So we'll also give you advice on how any of these should be implemented in your portfolio and what you should be doing in reaction to those announcements. In the studio with me, Pranav Saida, partner tax at Ernst & Young, and Narendra Kumar, the CEO of Value Research. Gentlemen, thank you so much for spending time with us this week. Pranav, I want to ask you this. There was, for me, the key announcement in the budget was the fact that as an employee, I now get to choose between the EPFO and the NPS. Has there been more clarity on how that will work? What happens to my employer's contribution, for example? Is it actually an active choice? Could you tell us exactly how that would work?
So one has to wait for greater details, but the concept as such, and the finance minister says he's going to pick up the debate now. But as I see it, that's a great initiative indeed. We are now realizing that our investor community has matured and they are able to take their own decisions. Probably this will also enable them to try and ensure that their own risk profile based decisions are taken. So I think it's a great move. One has to wait for far more details to be able to fully comment on to what extent and how exactly this will work.
Narendra, I want to bring you in here. Now, we saw the NPS be mentioned in the budget more than once. One, of course, is the additional deduction of 50,000 rupees a year. The fact that we can take it up to the entire 1.5 lakh rupees within ATC. And then the choice that we just talked about for all private sector employees. I want to talk to you about the NPS in general. Now, we've had a lot of questions from our viewers, and I want to take one that comes up right now. This was a question that came in on email. Karthik wrote in saying, so now, should I be investing in the NPS? Because I've been investing up till now in the ELSS. Should I just move that money that I've been dedicating to the ELSS to the NPS at this point? Because it does seem like the government is pushing that system more. Now, if I were to weigh the two, between the ELSS and the NPS, does the NPS now have better, is it better suited for an investor at this point?
No, I don't think, they're comparable on some dimension, if you look at, if you evaluate NPS versus the ELSS on key dimensions of tax advantage, I think ELSS has greater advantage because it's more liquid. Allocation to equity, I think it's the only all equity investment available. So I would say that it suits different kind of people. If you want to have a low cost, conservative, long-term investment strategy, NPS with the highest equity allocation permitted, which is a maximum of 50% to equity. So in that sense, the most aggressive plan of NPS which you can mix or can buy is will have 50% allocation to equity. Is still conservative. So from that standpoint, the return potential, the liquidity, and the tax advantage, I think ELSS will prove to be more high performance. For that 50,000 rupees special window for NPS, I don't think you have a choice. It is not ELSS versus this, but within ATC, I think anybody who has more than 10 years to invest in for his tax-saving investments, he should just go ahead with ELSS and will be much better off.
I'd go ahead with ELSS and you'll be much better off. Pranav, I want to bring you in here. Obviously, the government has been trying to push us towards investing, to deepening our financial markets, basically moving our long-term savings into the equity markets. Do you believe NPS is the way to go? Because like Narendra said, it hasn't been the most efficient system in terms of just accessibility. And in terms of equity allocation, it's fairly conservative. So is this the right way to go about it if the government was trying to encourage us to invest?
I think so. I think two things are happening here. I would agree with Narendra that it's not that the typical ELSS investor might move all his savings into NPS.
Well, this one might.
But what will happen is that there might be a lot of EPF that might move into NPS. And also this additional window of 50,000 will ensure a lot of new people enter the NPS. So you'll start tasting that kind of NPS flavor, which is a little bit of risk, but a higher return with a longer gestation period.
So if I were to pick up what you're saying that because now there is a tax benefit, investors will move towards NPS. When investors move towards NPS, NPS will be forced to become more efficient. So does that mean then that I should give it about 6 months for that efficiency to come in before I join in and, sign up for the NPS? Because I don't want to be the first person in line who suffers the change when it does happen. And we've seen that happen with a lot of government products.
Right. My sense is, at least for a certain category of investors, the high tax paying ones, they'll probably move into NPS very quickly. And you'll see in the first quarter of the next financial year, April, May, June, if things go right, they might start investing in NPS quite soon. So I would feel NPS should take off maybe in the next 3 to 6 months at the latest, given these 2-3 good initiatives in the budget.
All right, we're getting a lot of questions. I got a question on Twitter, in fact, from Samira Satyanarayan, who wrote in saying, does it make sense in terms of returns to invest in the NPS? On an average, if we look at the NPS funds from the time they were launched, they've given an average of 10 or little over 10% across the board. Over the last year, it's been closer to 20%, but the last year was a very good year for the market. Now, if you were to compare it to regular equity mutual funds or balanced funds, because that's a fairer comparison, because then you're talking about 50-50 equity to debt, are you impressed with how the NPS fund managers have performed?
No, the NPS fund managers are fairly impressive. In fact, they have to operate in a very defined boundary. The NPS funds are to be invested only in the Nifty and Sensex universe, stock universe of which is made up of Sensex and Nifty stocks. So I would say that they have to invest in large cap stocks only. But I would say that given what it is supposed to do and given a long list of things what they are not supposed to do, I would say that these returns are excellent. And it is also a relative, one has to look at it that what is the alternative. If you look at the investors who have the choice of investing in EPFO and they have to move their money to, or if they are at liberty to invest in NPS, assuming that last 4 years they would have earned 20% on their equity allocation, about 11% on their fixed income allocation, annualized on the average return, annualized. These are extremely, these are about 50% more return, even if we give it a 50-50 weight or even a 70-30 weight, 70% weightage to fixed income and 30% weightage to equity. Assuming it is 90-10, still you are much better off with NPS. These are all through a phase of the market which has not been very impressive.
All right, so what we're gathering from it here is simply this. The NPS is not an alternative for the ELSS. It is, of course, a very good alternative to the EPFO, the Provident Fund deduction that we have compulsorily going out of our salaries right now. And you say we should wait a couple of months to find out how we can make that switch or when the switch will be available to us. But Pranav, tell me this now, if it all does happen, what then as an employee I'll have a choice of is I can choose to go into the NPS and then within that NPS choose what sort of allocation I might have. Could you take us through that so our audience can understand it a little better?
So once you go into I have a choice whether to go through the PF route or the NPS route. And if I do choose the NPS route, what I must consciously recognize is that I must not get panicky, because the EPF return will be very constant, almost the same year after year after year. Whereas in the NPS, it is possible that in a particular year, the return may not match up. It might be a particularly bad year. But so long as you look at it from a longer term perspective, on an average, one feels that the return certainly would be much better. So one has the choice of doing a right mix. There is also a procedure whereby if one does not exercise the option, it goes into auto mode, where the risk level slowly reduces in the mix over a period of time as the age of the individual advances. But I think the individual, at least if he is wise enough with good advice, should make his choice based on his own requirements and risk profile.
All right, so that's the NPS. Now it is the buzzword after the budget, and you're all going to want to invest in that option. Now remember, we'll have all of the details as soon as we get them from the Finance Ministry on how all of this will play out and how you can make that switch if you want to from your PF deduction to the NPS. And of course, like we keep saying, it's not an alternative to the ELSS, so don't stop your ELSS SIPs in anticipation that you're going to have to make a switch. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. Remember, we talked about the NPS in the previous segment. We have to also talk about the health sector. The fact that the deduction on health insurance for you and me as average investors on the premium that we pay has been raised from 15,000 to 25,000 rupees and from 25 to 30,000 rupees for senior citizens. Perhaps this is a big move. There was obviously a huge push towards health insurance in the budget. Do you think that in some way, perhaps, this deduction needs to be linked to inflation within the healthcare sector? Because there's going to be a constant need to increase it with every passing year. This is not, this is not the finance minister's full-time job.
Right. No, it would be great if it can be linked, and there is no reason why it should not. It's only, I think, the aspect of simplicity which is keeping him from doing that. But the fact that he's increased it from 15 to 25 and for senior citizens up to 30,000 is a great step. I think over a period of time it is best to just link it to inflation, especially because we have historically a very high rate of inflation. Talking about inflation, of course, hopefully the inflation going forward will be far more moderate. And if that happens, then the increase in the limits will have to be far more moderate. But I don't see healthcare costs going down too much. And also given, the kind of competition that we have in the health insurance space, I think given that 25,000 is a decent limit for a couple, at least as of now, I think if they link it to inflation, he has to stop worrying about this limit and it automatically adjusts to, the future. So it might be a great move if he does that.
But Narendra, if you're also looking forward to a simpler tax system eventually in the future, like the finance minister said, that will not have any exemptions, it will just have low tax rates, then we should also get used to the fact that we buy health insurance because we need it, not because we have a tax benefit. Would you recommend that people who are watching right now go out and buy health insurance as high as they can get in, irrespective of what sort of tax deduction they're getting on that?
No, all your investment plan and all your future, investment projections, all your goal-oriented savings fails if you don't get health insurance. So I would say that, health insurance comes first in your scheme of, if you have to really prioritize things. In case of emergency, you will get into a debt trap and you'll be never be able to get out of it. Then comes, life insurance. If you have dependents, you must have it. If you can't afford the life insurance, then go for the accidental insurance. Just get a bit of it. I think investment comes second after you have taken care of the protection your family needs.
Let's also very quickly talk about the fact that he did mention the DTC. But he said everything that I would have brought in the DTC, we've brought in anyways. So that, axe is no longer hanging over our heads, because we had a lot of investors who were very worried about the DTC, saying, okay, if it does come in, what does it mean? Should I continue to invest?
Right.
So is the ghost of the DTC finally been, pushed away from the entire system? There's nothing to worry about there anymore?
I think so. I think we have to forget the DTC. The finance minister was abundantly clear in his speech. It's buried and forgotten. And I think it's best we don't spend too much time on the DTC, thankfully now.
All right, so the DTC is nothing to worry about. The other thing we must also talk about is REITs. And I'm going to bring this up with Narendra as well. But very quickly, for those of our viewers who have not understood what that tax pass-through on rental income means on REITs, could you take us through it?
Yeah, so what the finance minister has proposed in the finance bill this year is that if the REIT trust itself owns the property, and typically it will own maybe a commercial property on which it is earning rent, then the rent that it earns, the REIT trust will not be liable to any tax at all, and the investor in that particular REIT will directly be liable to tax on that rental income. So it's a pass-through for all intents and purposes. The REIT will withhold some taxes when it makes payment to resident, maybe 10%, to non-resident at the specified rates and so on. And to that extent, therefore, I can make a very small fraction of an investment into the REIT, which would be a fraction of an investment in the immobile property. In that sense, makes it far more possible for smaller investors to participate in the real estate investment story. So that's one. Though I do feel that this particular exemption that has been provided in a manner that the REIT trust should directly own the property and earn the rent. Typically in a REIT structure, the commercial property or whatever property is owned by an SPV, which SPV is owned by the REIT trust. In such an event, the exemption has not been made available. So that's the anomaly here. If the SPV, a special purpose vehicle, maybe a corporate entity, owns the commercial property on which it earns rent, and then the rent moves on to the REIT, which owns 100% shares of the SPV, then the exemption is not available to the SPV when it earns the rental income. Now, typically, for the promoter, the developer, the sponsor, to create the REIT structure, he would invariably want an SPV underneath the REIT owning the immovable property or the real estate rather than the REIT itself owning the real estate.
Right.
And the reason for that is that the exemption to the sponsor, the developer, the promoter is available provided he transfers shares of an SPV into the REIT trust. If he transfers the property itself, he does not get the exemption or the tax neutrality for movement of the property from his name to the real estate trust. And that's the reason why it is very unlikely that the REIT will directly own the property. The possibility which is more likely is that the real estate will be in a SPV which will be owned by the REIT. And in such a case, the rental exemption unfortunately is not available as the finance bill stands today unless it is modified before it becomes law. So that's one anomaly I think which needs to get addressed before the bill becomes an act.
But Narendra, if it does get addressed, and we know there are two funds right now waiting in the wings to start business in India as REITs, do you recommend it at all to investors who watch this show?
No, I would like it to really evolve. As I keep saying that, there is never a last opportunity. There is never an opportunity which will expire. Wait, and anyway, this is going to be an investment avenue. Looking at it from 2-3 dimensions in terms of risk, return, and liquidity. It is unlikely to be very high on liquidity. On risk and return, it is going to be a moderate because it is going to have many characters of a growth investment and some characters of an income investment. So I would say that let it evolve, let things granulate. A lot of operating procedures will get formalized. And anyway, I think that it is, these funds, whenever they are sold, they will be sold at very wealthy individuals, not individual investors to begin with. So I don't visualize that small ticket investors will be able to participate. Anyway, it is going to be, they are likely to be designed as a closed-end structure. So it will be a one-time investment avenue. Let few funds come, evolve, formalize themselves or demonstrate their ability to derive this. This is a murky sector, and we have to see that, besides the tax clarity or the regulatory clearances for such a structure, I think there are a lot of unsaid things which will get proven in the operational form. So I don't think investors should rush to invest in REITs as and when they become available.
All right. So as always, you always give an investment a certain amount of time to see how it performs and if you're comfortable with the kind of risk that pops up. And then you decide whether or not you want to invest. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We're now going to talk about the interesting announcements that were made in the area of gold. There was a gold monetization scheme and the sovereign gold coins, along with a very interesting Indian gold coin, but we'll come to that later. Tell me, the sovereign gold bonds, how will they be different from, say, a gold ETF or a gold fund that I can now buy, which is basically fundamentally demat gold?
So the way I look at it is there are 3-4 advantages that a sovereign gold bond could have. One, the fact that there may not be any expenses, unlike a gold ETF scheme where there will be some expenses. Second, it will mimic the price of gold almost completely. The gold ETF is close to it but does not necessarily mimic it completely. Third, leave alone expenses, it's actually going to earn some interest. And therefore, the sovereign gold bond has all these 3-4 advantages, which means the return that an investor gets will probably be definitely much higher.
So you're saying there'll be no expenses, there'll be no tracking error, plus I'll earn an interest over and above the capital appreciation that gold will give me.
Absolutely. One has to wait for the exact scheme to come out, but as I envisage this particular sovereign gold bond, it will run something like this, that if an investor has invested X sum of money, that particular amount of gold value is frozen, and on the maturity of the bond, he gets back value equivalent to that quantity of gold. So in short, it's tracking gold prices absolutely perfectly, unlike an ETF. That's one. Second, there's no expenses like an ETF or a mutual fund would have, but actually it's tracking the price of gold completely. Third, the sovereign bond will carry some interest. It might be a low rate of interest, maybe 1.5% or 2%. But even if it's a 1.5% interest, apart from the fact that I have the gold investment intact with the price of gold as is, I additionally get an interest rate of 1.5%. I don't have to take care and have a safe deposit locker to take care of the gold. So in that sense, it's better than a physical investment in gold. It's better than an ETF also. because I get an interest, no tracking error, no expenses. So those are, I think, the advantages. The one thing that I would feel we need to be clear about is how will the redemption gain be taxed? Will this particular sovereign gold bond be tradable? What is the kind of liquidity that it will have? Will I be able to sell it prematurely, or will there be a market for it? How mature will that market be? So those are the kind of things that I need to look at from the negative side. Unlike an ETF, which I can sell at any time and in cash and so on and so forth, because it's tracking the price of gold almost regularly. I also need to understand what would be the tax implications. In an ETF, I do get an indexation benefit. But in a sovereign bond, if I'm going to be denied the benefit of indexation, and assuming the price of gold increases because that's what I anticipate when I'm investing, then would the capital gain be taxable in a more inefficient way because no indexation is available, versus an ETF where capital gain indexation is available. So those are the things I think we need to wait for to get the exact details. But I think for the government to make it attractive, they must give a parity of treatment. So they must allow indexation benefit, which may not be available if the law stays without any amendments as is. So I think they must bring in adequate liquidity to this instrument and must bring in indexation benefit for this instrument.
Well, Narendra, you were never a big fan of investing in gold. You always tell our viewers to stay away from gold, especially over the long term. But for those of our viewers who are maybe planning for an event in the future, a wedding 5 years down the line or 4 years down the line, and they're putting some money away to match the price of gold, do you think that this sovereign gold bond will be, like Pranav said, a decent alternative perhaps to the ETF or the gold fund?
For very sophisticated investors, I would say that, if that event is, 5 year, 10 year away, let your money grow, gain in value optimally. And the very reason, investments are made and they are fungible. When your money grows, you can actually buy whatever gold you want to buy or whatever else you want to spend it on. So in that sense, I'm more optimistic about, sophisticated investors should take that view. But, there are investors who are psychologically or, more comfortable that they are allocating something for a certain goal in the same form itself. And gold has its own charm for historic reason. So I would say that for those investors, yes, one additional thing which comes to my mind beyond all that Pranav said is that it will be extremely convenient to buy these bonds. It will be an over-the-counter sale. When you buy ETF, you have to buy, when you buy the gold ETF, you need a demat account, you have to place the order, you have to worry about the premium or discount to NAV. So you have to learn a whole new method. In that sense, this has the potential to democratize the ownership because you will be buying it across the counter.
All right. So remember, if you are buying gold, like Narendra said, just buy it as a consumption and not as an investment. Always on the show, we say gold is not a very great investment. And both Pranav and Narendra, thank you so much for answering our questions this week. We hope to have you back again because I'm sure these things are going to pan out over the next couple of months and we'll have more questions for you. If you have a question about anything at all that you heard, write to us. Our email ID is at the bottom of your screen. You can also reach me personally on Twitter. Gentlemen, thank you so much for your time.
Thank you.
Thank you so much for watching.